Managing trading capital effectively is not about math formulas or clever position sizing tricks. It is about survival psychology dressed up as finance, because capital is not just money. It is time, emotional bandwidth, and the right to keep playing the game tomorrow. I learned this lesson slowly, painfully, and expensively across multiple market cycles, watching talented traders disappear, not because they were wrong about markets, but because they were careless with the one thing the market never replaces once it's gone. You can recover from a bad trade, even a bad year, but if you mismanage capital at the wrong moment, the game ends abruptly and permanently. Early in my career, I thought capital management was a secondary concern. I focused on entries, setups, indicators, and ideas. Risk management felt like something conservative people talked about because they lacked conviction. That belief didn't survive contact with reality. During the dot-com era, I watched accounts double quickly, including my own at times, and that success quietly rewired my sense of risk. Positions grew larger. Losses felt temporary. Capital felt abundant. What I didn't understand then was that abundance is the most dangerous illusion in markets. When capital feels plentiful, discipline loosens, and when discipline loosens, drawdowns accelerate faster than you expect. The first true lesson in capital management arrived not as a theory, but as a shock. A series of losses clustered together, not because my analysis suddenly failed, but because my position sizes were built for calm conditions, while the market was transitioning into something far more hostile. Losses that should have been manageable became emotionally destabilizing. Decision quality degraded. I started trading to recover instead of trading to execute. That spiral had nothing to do with strategy and everything to do with capital pressure. When too much of your account is at risk, your mind cannot function clearly, and clarity is the real asset you are protecting. What experienced traders eventually understand is that capital management starts with defining how much pain you can tolerate without changing who you are. This is rarely the same as what you think you can tolerate on paper. Everyone believes they can handle a 10% drawdown until they actually live through one and realize how it changes sleep confidence and decision-making. Effective capital management is built around preserving emotional neutrality as much as financial capacity. If a loss makes you hesitate, rush, or revenge trade, it was too large, regardless of whether it fit a textbook rule. Another dangerous misconception is equating aggressiveness with professionalism. In reality, professionals are aggressive about protecting capital and conservative about risking it. They understand that risk is not linear. A 50% drawdown does not require a 50% gain to recover. It requires a 100% gain, and that asymmetry is brutal. Every additional percentage of drawdown makes recovery exponentially harder, both mathematically and psychologically. Capital management exists to prevent you from entering those deep holes where rational behavior becomes almost impossible. During the 2008 financial crisis, this lesson separated survivors from casualties. Traders who risked small, predefined portions of their capital could adapt, reduce exposure, and wait. Traders who went all in on conviction, even if that conviction was ultimately correct, often broke before the market confirmed their thesis. Being right is meaningless if you are forced out before the outcome arrives. Capital management is what allows you to be patient enough for probability to work. Another subtle but critical aspect of capital management is adaptability. Risk should not be static. It must respond to volatility, liquidity, and your own psychological state. When markets become unstable, position sizes must come down. When you are tired, distracted, or emotionally charged, risk must come down. Ignoring internal conditions is just as dangerous as ignoring external ones. Your capital does not exist separately from you. It is deployed through your decisions, and your decisions are filtered through your mental state. Over time, I stopped thinking of capital as something to grow aggressively and started thinking of it as something to protect intelligently. Growth became a byproduct of consistency rather than a goal pursued directly. I accepted slower returns in exchange for durability, and that trade-off turned out to be one of the best decisions I ever made. The irony is that once I stopped trying to force growth became steadier and more reliable because I was no longer sabotaging myself during inevitable losing periods. As this perspective settles in, you begin to see that effective capital management is not a restriction. It is freedom. It frees you from desperation. It frees you from needing every trade to work. It frees you from emotional whiplash. And that freedom is what allows you to execute your edge cleanly over hundreds and thousands of trades instead of a handful of emotionally charged bets. And this is where we need to continue next, because understanding that capital management matters is only the first step. The real work is in translating this philosophy into concrete rules around risk per trade, drawdown limits, scaling, and adaptive sizing that actually protect both your account and your psychology in real market conditions when volatility spikes and temptation is loud, and you feel the urge to push just a little harder than you should. And that transition from principle to practice is exactly where most traders stumble, and where disciplined survivors quietly separate themselves from those who eventually vanish from the market without understanding exactly why. And that is where we go next. As this sentence carries forward into the practical framework for managing trading capital in a way that keeps you alive, sane, and consistent long enough for skill to compound into lasting results. And that continuation begins right here as we move into how to actually structure risk so that capital management becomes automatic rather than aspirational. By turning that philosophy into rules you can follow automatically, because capital management only works when it removes discretion at the moments you are least qualified to use it. The first rule I live by is defining risk in account terms before I ever think about a trade. I do not start with where price might go. I start with how much of my total capital I am willing to lose if I am wrong, and that number is deliberately small. Not small because I am fearful, but small because I want my mind to remain intact after the loss. If one losing trade can change how you think your risk was already too high, from that foundation comes risk per trade. Over the years, I learned that risking a fraction of a percent consistently beats risking a few percent. Occasionally, not because the math is clever, but because the psychology is survivable. Small controlled losses keep your nervous system calm. Calm keeps your execution clean. Clean execution is what allows an edge to express itself over time. Traders who blow up are often right about ideas, but wrong about scale. They turn what should have been information into trauma by risking too much too soon. The next layer is drawdown rules, and this is where most people fail to be honest with themselves. You must decide in advance how much drawdown you will tolerate before you change behavior, not just feel bad. That might mean reducing size, reducing frequency, or stopping entirely for a period of review. These are not emergency measures. They are planned responses. During 2008, and again during COVID, the traders who survived best were not the ones who pushed harder during drawdowns, but the ones who slowed down deliberately. A drawdown is not a signal to recover faster. It is a signal to protect clarity. Scaling is another underappreciated tool of capital management. I almost never deploy full size immediately. I probe. I add only when the market confirms my idea, not when my conviction increases. Conviction is cheap. Confirmation is earned. This approach does two things. It limits damage when I am wrong, and it rewards patience when I am right. Scaling is not about being indecisive. It is about aligning risk with information as it becomes available. Adaptive sizing is equally important. Risk is not static because markets are not static. In high volatility, low liquidity environments, my size comes down automatically. In calm, liquid conditions, it may increase modestly. The same applies to my internal state. If I am tired, distracted, or emotionally charged, my size comes down, or I do not trade at all. This is not subjective weakness. It is objective risk management. Ignoring your own condition is no different from ignoring a volatility spike on the chart. One of the most powerful shifts I ever made was separating capital growth from capital protection. Early in my career, I treated every dollar the same. Later, I realized that protecting capital during bad periods matters more than maximizing returns during good ones. If you can limit losses when conditions are hostile, the good periods will take care of themselves. Most long-term success in trading comes not from extraordinary winning streaks, but from avoiding extraordinary losing ones. I also learned to keep part of my capital psychologically untouchable. Not all funds need to be active. Holding cash is not failure, it is optionality. Cash gives you flexibility, patience, and perspective. Traders who feel fully invested all the time feel pressured all the time. Pressure leads to mistakes. Optionality leads to better decisions. This lesson took me years to fully appreciate. Over time, these rules changed my relationship with the market completely. I stopped fearing losses because I understood them. I stopped chasing because I was no longer desperate for growth. Capital management gave me something far more valuable than aggressive return stability. And stability is what allows you to stay in the game long enough for experience to compound into wisdom. That is the essence of effective capital management. It is not about squeezing every dollar out of every move. It is about building a framework where no single trade, no single week, and no single mistake can define your future. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue learning from real market experience rather than shortcuts, and leave a comment sharing the risk rule you struggle with most, because identifying that weak point clearly is often the first step towards strengthening it and protecting the one asset. The market never gives back once it's gone your capital.